Okay, welcome in. This is the Thursday Deep Dive Show. We're talking Five Below today. It is a retailer I think a lot of people know about in the Pacific Northwest where Ryan and I are. We don't have any stores, so I'm actually going to ask Ian, who's joining us. You got any Five Belows down in the Arizona area? You ever been to one?
Yep. So we do have some Five Belows. I went to one the first time about a year ago. I was actually looking for a mask, and I walked in, and I'd never been in. My sisters had talked about them. I was like, "Wow, there are a lot of good deals here." And so that's kind of how it first popped up on my radar, and part of the reason we're talking about it today. But they've started popping up everywhere in Phoenix.
Yeah, I mean, we'll talk about it. They're trying to grow out to basically everywhere in the United States, but we're gonna. Oh, actually, wait. We're going to talk Five Below. We got to do sales pitch. Who wants to do it? Ryan, you or you?
Yeah, I think I am probably the best salesman. So,
okay, go ahead.
It's code CCM. Go to 7investing.com. They have, if you are unfamiliar with 7 Investing, they have 7 great recommendations every month with good analysis. We love the advisors over there. And you can use code CCM to get $10 off. So $7 for your first month. It's a price of coffee. But it's gonna afford you many coffees in the future.
Maybe 2. I think we're thinking about coffee in New York. $7.
No, a Starbucks coffee, a fancy coffee, you can get. It'll be $7.
Wow. All right. Well, maybe I'm siding with Barbara Corker. Maybe we get a stop. Maybe that will make you a millionaire someday. Ryan, do you want to get into what Five Below does?
Yeah. So the first line on their investor relations page says Five Below is a leading high growth value retailer for tweens, teens, and beyond, offering trend right, high quality products with extreme $1 to $5 value, plus some incredible finds that go beyond $5. So they're a lot like a dollar store. But they're a little more upscale. I haven't been in one, so maybe Ian can attest to that. But they sell items across 8 categories. So it's style, room, sports, tech, create. I double typed create, party, candy, and now.
Now, what's that? What's
like probably just relevant, trendy stuff.
Oh, just kind of the other.
Almost. Yeah, and basically you're getting all this stuff for below $5 or above $1. So it's really like cheap value kind of little handy things. And their goal is to make it an entertaining, cheap experience. They try to change out the inventory constantly to keep up with trends. That's why they say trend right. And this hopefully keeps people coming back so they never know what they'll find. At the end of this year, they had 1,020 locations in 38 states. As we mentioned earlier, there are none really in the Pacific Northwest.
You got to pick up the slack there. Come on, Five Below.
And their new store models are about 9,000 square feet. So if you're trying to gauge how big that would be, we've talked about Sprouts Farmers Market on here before. That's about 26,000 square feet. So it's about a third of the size of that. Which are small. Sprouts was the perfect example.
Yeah, I mean, they're small stores. They're not right. They're way smaller than a grocery store.
Like Walmart is 100,000 plus square feet. So think about it that way. And they're typically centered in like high traffic areas. So big shopping centers, stuff like that. And as for the supply chain, Five Below has about 1,000 vendors with 60% of the materials being sourced domestically. No vendor makes up more than 5% of their purchases, and there are no long-term vendor agreements. So and none of them are exclusive either. Supply chain is a huge deal for a value retailer like this. If they can't acquire the materials for cheap, then obviously economics don't make any sense. But for distribution, they have 4 distribution centers scattered across the U.S. Sometimes vendors will ship directly to the stores, but usually it goes through the distribution centers. And then I think e-commerce comes from distribution centers straight to the consumer's home. But e-commerce is a very small part of the business, and I'll get into the history. So there wasn't a whole lot of stuff on the early days. The first Five Below store was started in 2002 in the Philadelphia area by a guy named David Schlesinger and Thomas Valois. And as you might imagine, if you're starting a store called Five Below, you probably have an interesting background. So Schlesinger had recently founded Zany Brainy and Encore Books. I know some of these names are a little crazy.
They have some unique names for sure for stuff they do.
Yeah, and Valois was the CEO at Zany Brainy. So him and the other guy worked together, and then they decided to start this Five Below store in Philadelphia, which the company was originally called Cheap Holdings Incorporated, but the name changed within a year. And then Joel Anderson joined the company in 2014, and he was appointed to CEO within about 6 months. So I think they knew that he was talented. And they introduced online selling in 2016. But yeah, within 19 years, they've grown store count 1,000x.
Yeah.
So,
well, you're starting at one. Yeah.
Yeah. But 1,000 stores in 19 years is
That's pretty good.
Pretty fast expansion.
Yeah. And I'll hit the industry and landscape. According to the 10K, there's about 63 million people in the US that are ages 5 to 19, which is their core market. They're going after, and I've never been to a store, but the way they describe it, it seems like really the target market is like 5 to 13. And they're trying to get that. So I imagine it's kind of like you're at the mall, you're going out for shopping with your family as a kid, and you're like, all right, like asking your parents, hey, can we stop off for 15 minutes at this Five Below store? That's kind of their value proposition. Management believes they have room to get to 2,500 stores in the US, so about 2.5x from here. Other discount retailers would be, and really when looking at it, they kind of have a unique proposition. So it's not like they're directly competing with all these, but they sort of compete with Dollar General. They sort of compete with Dollar Tree, Big Lots, even like a CVS pharmacy, party stores too. I think party stores is one that probably people don't look at as much because they are kind of that, for the kids' birthday parties, you'd probably go to a Five Below too. And then Amazon, Walmart, Target, like every retailer imaginable, they're competing with those three. Total industry is estimated to be about $94 billion in 2021. And, Five Below is going after a smaller market of that, but there's still a lot of room to run, I guess, in the TAM, although that's not really something people should consider. Ian, do you have anything on the introduction here before we get into management?
Yeah, so first, just touching quickly on the competitive landscape, one number that they cite is that 46% of their visits to their stores are actually the second visit in a shopping center. So someone went to a shopping center for some other reason, and then they ended up at Five Below. And so they really are trying to build their model around being in good locations that they can get some of that kind of other traffic into their stores. And I will say, just having the Phoenix influence here, my experience, like you walk into the store and you have your little kind of checkout area at the front, and you can see the back of the store from the front of the store, and you can see both of the sides of the stores, right? It's not like some of these shopping centers or these huge things that are like really big. It seems like there seems like plenty of space there. It's not a small store, but it's also not overwhelming. You can make your way around it in about 10 minutes or something. So anyways, getting into management and ownership, Joel Anderson is the CEO and president, as Ryan mentioned. He was hired in 2015. Before that, he was the CEO of Walmart.com. So kind of one of those, like the subsidiary of Walmart, basically, and focused on the e-commerce side of it. And then before that, he worked in multiple kind of executive positions at Toys R Us. And so has experience in retail, discount retail, children's, teens, tween retail. And so kind of a pretty good track record for someone that you're trying to get in a position like this. And it looks like the transition went really smoothly from the existing team to Mr. Anderson. So one quote that he said that I think is interesting is he said, too many leaders focus on performance first. I believe you have got to start with people. Everything I've done when I've moved to a new company has always been about people. Sometimes it's meant changing people or encouraging current people. But in all cases, to be successful will require starting with the people. If you have the right people on the team and then passion for the customer in that order, then performance will come. So, or end quote. So sometimes like we hear a lot of comments like that from management that I think they're like saying the right thing, but it's not actually played out. But in this case, I think it has played out. Most of the management team is basically from when he started, if not before. And so he's kept on a couple of existing people, and most of the other members in the management team came around the same time that he did. So there hasn't been a lot of turnover. He's found his team, and they've really had some great success over the last couple of years. In terms of ownership, about 6% of the float is shorted. So some short interest, but nothing too insane. It's not like a GameStop situation or anything like that. Insider ownership is about 2%, not large, but not nothing. Mr. Anderson has about 0.5% of the company, which is about $50 million. So a pretty substantial amount of money for him. He's getting fairly large equity grants each year, but it looks like he's selling some of those to presumably pay for his lifestyle. But nothing, I'm generally, from what I can read and hear about Joel Anderson, he seems like a competent guy who's really executing on the vision so far.
Yeah, I like management a lot. It seems like even reading the transcripts, I don't know. It's kind of hard. Like, it's hard to describe, but when you read a transcript or even listen to it, sometimes you're like, all right, they got a fantastic grip on this business. And sometimes you're like, all right, you kind of just go, meh. Him, it was like, all right, this is fantastic.
Yeah, and the other thing about it, and you mentioned the transcripts, is they give a lot of information both in their 10K and in their conference calls, giving whether it's guidance or they were talking about like how they plan to build some distribution centers this year and how much that's going to cost. They try and give people some really kind of clarity into the business as they see it. So that's always nice to see. Kind of makes you feel better about management too, when you feel like they're being upfront with you.
Yeah, that doesn't seem like they're hiding anything. No. All right, I'll get into the valuation. Ticker is FIVE, so 5, very easy to remember. Market cap right now is about 10.96 billion. So round that up to about $11 billion. Price to sales 5.6. Price to gross profit of 16.8. So a little expensive there. They're not a high margin business, so don't look at that sales ratio at all and think, whoa, under 10, cheap. We're kind of in that, I don't know, part of the cycle. I don't want anyone to think that. Price to operating income when looking at the trailing 2020 numbers was 70.8. But remember that 2020 is a down year for a lot of retailers like this. I think their comp sales went down like 6%, but Ryan will probably get into that. So really normalized operating income is likely a lot higher, and they're still kind of in investment mode. Share count has stayed extremely steady over the last 5 years. So really nothing positive or negative there. They have a small buyback that's not really meaningful, and then no dividend. Besides that, I'll just kick it over to Ryan for earnings.
Yeah, so the earnings were lumpy in 2020, as almost every business has had lumpy earnings, but revenue actually increased 6% to about $2 billion. But that was despite a 5.5% decline in comp store sales. So it was basically just offset by new store openings. Operating income fell 30% year over year to, I think, I might be blanking on the number, but it was around like 150 million.
Yeah, I think it was 180 million possibly.
Okay. And but when we look at Q4, revenue was actually up 25% year over year, driven by 14% comp store sales growth. They increased store count 13% over the last year. And then operating income grew 18% year over year. So strong numbers across the board in the fourth quarter. And they're planning to add another 170 to 180 stores in 2021. But normalize their operating margin is probably somewhere around 10%, roughly.
Yeah.
I think that's what it was in 2019. I'll try to pull up the numbers here, but Ian, you want to go ahead and hit balance sheet?
Yep. We've got a pretty simple balance sheet here. They've got cash of around $410 million. No true debt, but they do have leases, which oftentimes we consider debt. And that's, they lease out all their stores. They don't own any of the properties. And they're typically around 10-year leases with options to renew past that. So not super long-term leases. So a little bit of flexibility there if a location really isn't working, but their leases total about $1.1 billion in liabilities. Like I said, the balance sheet looks pretty solid to me, pretty simple. One last thing I'll note is that inventory turnover is something that you should keep an eye on, and management is actually generally incentivized to increase inventory turnover. It was actually up a bit in the last year, and that was because they reduced inventory by about 10%. And so they had a little bit more sales, but then also less inventory on the books. And so they kind of ramped down inventory during COVID. I expect that they're trying with these distribution centers, as Ryan mentioned, the supply chain is really important. And so they're trying to find ways to increase the efficiency of their inventory management. And then they also implemented a new inventory management system. So they're making some efforts to try and keep that inventory number as low as possible. But balance sheet looks good. Should be plenty of capital to fund growth in the future. They're cash flow positive, so not a lot of concerns there.
Yeah, fine. And their leases are operating leases, not finance, right? Like you said. So it's not like that debt there. I mean, they're liabilities that they will have to pay, but it's not like it's not the same as long-term debt.
Yeah. And I pulled up the financial statement here. Yeah. Operating margin is typically, or net margin is typically just below 10% on a normalized basis.
Okay.
This year was a little lower, but that's
Yeah.
kind of where it usually ranges to.
Okay. All right. That'll make sense. Let's take a break and then we'll get back for the second half of the show. All right. Welcome back. Next up is going to be competitive advantages for Five Below. We'll kick things off with Ian. What are your thoughts here?
The competitive advantage that I'd like to look at today is that they have an established niche. So they target that teen demographic, and they've done a really good job at it. So that helps them to focus their marketing, to focus the store layout, all of those types of things to that audience, rather than being someplace like Target where they do sell items that are in this price point for this audience, but it's not laid out or set up or all those types of, there's just little things that the company can do that really helps maximize the sales that they have with their core audience. And so I think that established niche also helps them choose different locations, have smaller building sizes, smaller footprints than like something like a Target, even something like a Party City. So just between prices, goods, inventory, experience, and location, it's all catered to capturing that 5 to 19 market.
Yeah, as long as a kid doesn't want to go to Costco or Target and they want to go to Five Below, I think it's hard to describe that as like a competitive advantage, but it feels like that as long as they keep that up, that'll ring true.
And I haven't been in one, but people say it's entertaining. Like people say it's kind of a fun experience for that age demographic, whereas like the dollar store or Dollar General isn't necessarily like you're going there to get really cheap stuff in a similar way to Five Below, but it's not like fun.
Yeah.
Maybe it is to some people. Yeah, Ian.
Yeah, and I would say like the interesting thing about Five Below is it was funny to me when I started researching the stock, because when I walked in, maybe this just means I'm more of a tween than I realized, but it seemed like a cool store to me. I was like, oh, wow, look at all these great deals. And I can walk around it in 5 minutes and just, I picked up a couple of, I like never shop, but I actually enjoy the shopping experience there, which is why I started looking at the stock, because I was like, this is so bizarre to me that I actually am somewhat enjoying the experience here. But part of it too, I think is, and this isn't I don't want to make a blanket statement, but sometimes you walk into those dollar stores or Dollar General or whatever, and it feels like it's not super clean, or there's like random items all over the place. This felt really well merchandised. Like it was at least the ones that I've been in have been clean. They've been organized. It's been easy to see where the different sections were. You could find everything really fast. And it was kind of easy to just roam about the store, rather than like sometimes in those other dollar stores, it's not, like you said, it's not really a fun experience. It's maybe a little bit messy, a little bit cluttered. So anyways, just my 2 cents.
It honestly, like when I was going through the industry, it seems like, you can say like, all right, there's all these competitors in retail, but it really seems like there's not any competitor. I mean, I can put on my Galaxy Brain hat and say that maybe Roblox is their competitor. I know that's the hot name that everyone talks about now, but it's really like the place where people, or kids are going to interact and buy things for themselves and, gifts for each other.
It's funny that you mentioned that, because that's going to cater well into my future growth opportunity.
Okay. All right. Ian, I think Ian has
you got anything else?
Yeah, I've got one last thing. I think when you're looking at Five Below, and I think there's other businesses like this as well, that this is kind of a helpful framework, at least for me, to analyze some of these businesses. So I think sometimes about who are the business model competitors and who are their target market competitors. And so in this sense, we'd say like the business model competitors would be things like Dollar Tree, Dollar General, kind of those competitors that are really trying to find bargain, like, and you can match their type of business model to build your own models about what you think Five Below will look like in the future. But when you're talking about capturing a market, they're not really competing against Dollar Tree or Dollar General for the most part, and trying to get that same audience. It's actually 2 different audiences, but they have similar business models in these 2 audiences. So that's kind of how I think about this business. I think there's other businesses, because like it's kind of a joke, but like you said, like even Roblox could be a little bit considered like a target market.
Yeah. Spending money. Kids are spending money. Yeah. So
okay. Yeah. I'm gonna dive into my competitive advantage, and that is basically against sort of the digital retailers, e-commerce for tiny goods, like stuff that's less than $5, especially if you're buying it like just a singular item. The shipping and logistics, it doesn't really make practical sense. The economics of shipping one tiny item, because there's so much cost that go into the back end of that. So, I mean, Amazon can afford to lose money doing that, but even Amazon, even Amazon tries to, I think they try to sell kind of this stuff in bulk.
Yes.
Because it just really doesn't make sense. I mean, if you're pairing it with something else, Amazon has that infrastructure to ship that kind of stuff well, but like one tiny item, like shipping one mask, probably doesn't make a whole lot of sense. And so this is something that feels like it won't be digitized that much. This shopping experience of little $1 to $5 items, I think, will always be done physically in person. So I guess there's that niche, or that advantage, that this is just something that's sort of immune to digital changes.
Yeah, and with the e-commerce, okay, Amazon is really more of a utility for like adults like us.
Yeah.
And Five Below, like I haven't been on their website, or actually no, I checked it out for a little bit. It's really catered for, a kid's experience. Yeah. Where they could like check it out, and it's like probably a great way to, I don't know, send a gift to your cousin in Texas.
And even their e-commerce, I didn't look at the numbers, but Ian, you said it's a pretty small portion of overall sales, right?
Yeah, they don't report exactly what it is, but they say it's not material at this point.
Okay. And if they're saying it's not material after a pandemic, like this feels like something that's probably not going to go digital.
Yeah, for sure.
All right, what do you have?
I think this one's easy. There's classic economies of scale, so they're going to get to 2,500 locations, or they're guiding for 2,500 locations. They're going to end up having better negotiating power with suppliers, either to get that accounts payable a little later or whatever that would help with cash flow. They're going to be able to use that to get lower prices for their customers, and then they'll be able to stay profitable at the same time. That gives them an advantage over the mom and pop shop. It's no different than any other retailer in that instance. You could probably compare it to, Walmart or Costco in that sense. But that model works so well because the advantage and the moat they can build is just really strong. I mean, I guess, again, Dollar General has that as well. I don't know much about Dollar General, but from what I've read, it seems like they've been able to, just keep prices low through their economies of scale and the ability to get a store up and running rather cheaply.
Yeah, the supply chain seems like an advantage. I mean, maybe it's not a competitive advantage, but the fact that they're able to acquire all their materials so cheap allows them to, that is their entire customer value proposition, is the cheap experience that these customers get.
Yeah. Ian?
Yeah, and then two other quick things on that. I think you also get, they have some branding agreements. Both they were doing some stuff with Fortnite and some Fortnite gamers, I think, to do special plush dolls of your favorite Fortnite star or whatever. So they kind of are able, because they're so big, they're able to cut some of those deals with places like Fortnite, places like Disney. And then the other thing that I've just started realizing a little bit more of the Five Below, once you have a big established store footprint like they do, or store network like they do, they've got over 1,000 stores. They get to do a little bit of the A/B testing, kind of like we talk about Facebook doing a lot. With as many users as Facebook has, they can do all sorts of testing in all these different in all their apps to all of us to see what works the best. Five Below can do the same thing in all these different locations and try out new new floor layouts, which they do from time to time. They can try out they've started selling some other goods that are a little bit more than $5 in some locations and seeing how that works. And so it gives them the ability that a startup wouldn't necessarily have, to test things out and see how it works.
Yeah, that does make sense. Yeah, I'll agree. Ian, do you want to hit up what is next? Future growth opportunities.
Yep. So Ryan's been mentioning e-commerce as that it doesn't make a whole lot of sense for Five Below, and I think I agree. However, they do mention it from time to time, and they say, the CEO is the former CEO of Walmart.com, presumably has some affinity for e-commerce. He said, quote, Our e-commerce business continues to grow at a pace significantly faster than our stores. However, due to the small base, the overwhelming majority of our sales still come from our stores. Close quote. So I'm not sure exactly what I think of this. I don't know how much growth is there. I agree with a lot of the points you were making, Ryan, that I don't think that this is probably geared towards e-commerce, but I do start thinking about some of that, especially as they grow out more and more stores, some of that omni-channel kind of method where you might be able, they could even put out lockers outside their stores and say, hey, build this, make an order and then come pick it up at our store just to get a little bit of some incremental sales. But what were you going to say, Ryan?
Yeah, and I think they just signed a partnership with Instacart as well. But
That's true, yeah.
the I think that that Fortnite sort of angle, when you take it from your maybe just becoming the logistics infrastructure for vendors, could present some good stuff in terms of e-commerce. So if you're buying a plush doll or whatever of a Fortnite character they just signed, this goes into my future growth opportunity, but they just signed some deal with Gouda or Buddha or he's like he won the Fortnite World Cup in 2019.
Wow.
So he's like this big sort of character in esports. So if you're doing stuff that way and you can kind of just, maybe people don't know it as a Five Below item, but they're powering that back end, that could be a big sort of tailwind for the e-commerce side. And then my growth opportunity was esports. So they made an investment in a company called Nerd Street Gamers, which is it's a Philadelphia esports network. So they host events, tournaments, that kind of thing. And in the fourth quarter, Five Below opened 3 local host test centers. So, and they're basically they're adjacent to a Five Below store, so it'd go right next to it. And then local host is a training center for gamers, which it seems like a strange narrative to go that way, but becoming synonymous with gaming might help on the e-commerce angle.
Yeah, there's a lot of factors going into the e-commerce market for them because they have to weigh the fact that a lot of their items, Five Below, it's going to be really cheap, but it seems like there's some opportunities there, but it's not going to be as streamlined of a process as like, all right, we're just going to keep opening stores, keep this model going. There's a lot of variables at play.
What do you guys think about the esports angle? Because it seems random.
No, I think it's smart because it's huge for that age group. And the fact that you can come into, I don't know what these partnerships are, honestly, I didn't look, but any sort of esports partnership, I know that my younger cousins love watching Twitch. So I think that the market overlap seems strong. Ian, what do you think?
Yeah, I think just exactly what you were saying. They talk about being, quote, trend right and really trying to just be with the times. And that's so important for that tween teen demographic, is that you're with the times. You don't want to be last year's stuff. You don't want to be, you don't want to be boring anymore. You don't want to be out of style. So I think for now they're making those investments in esports, and will it last? Who knows? It depends on how big esports will continue, but I trust the management team to continue to invest in things when it looks profitable and pivot when it starts going out of style.
Yeah, this is the interesting part about their business is they're going to have people graduate from their target demographic, but they hopefully are going to have new people entering each year. But the only downside with that is that, you have to adapt with the times. I'll hit my future growth opportunity. I'm stealing the easy one. Plenty of room for store growth. They have 1,000 right now. They're opening over 100 each year. And if they can get to 2,500 stores and keep up some solid comp store growth, there seems like an not easy path, but you could see, $8 billion in sales. That's a lot higher than now, but sometime by 2030, the model is so predictable that unless there's a huge change in either the culture or I don't know, if someone comes up with some innovative thing in e-commerce, there's a hard reason to think why they wouldn't be able to get 2,500 stores out there. And at that point, maybe they could get their margins up to, 12% instead of 10% now. I know that doesn't seem like much, but at that point, you could be pushing close to $1 billion in income. I don't know. That's pretty speculative. That's a lot far out, but there seems to be a clear path to store growth.
Yeah, and 2,500, it doesn't have to stop there. Like if they see expansion, it could go beyond 2,500. That's just what their minimum goal or target is.
Yeah, it's kind of their target. What would that be? It's probably by sometime like 2030, maybe.
At this pace, probably before that.
for that with
They're going 180 stores this year.
Yeah, but they got that's 7 or 8 years. Yeah.
Yeah. All right. Yeah. Highlights and lowlights. Ian, you want to go first?
Yeah, mine kind of go right in line with what Brett was saying. Simple model, currently with just about 1,000 stores, growing to 2,500. There's just, you see the path, right? It's easy to see where this thing is going as long as things stay on track. And then on the margin point too, they've talked a little bit recently that this is going to cause, like, adding all these stores is going to densify the model, meaning that there's going to be more stores in each city, there's going to be more stores in each state, which creates a little bit of cannibalization. They're seeing about 1% of sales when they build a new store. Sales at surrounding stores drop by about 1%, but the additional sales more than make up for that, and the additional brand recognition more than make up for that. And so the other piece of densification, though, that they like is that it increases the margins at these stores because they're spending less on marketing, they're spending less on distribution because they've got more stores that are close to each other, and so their supply chain becomes more efficient. And so it seems like this is going in the right direction, and the model is going to get more efficient as it gets more mature. So it's kind of that double whammy there that I like to see. I will say, as far as lowlights, it's a little bit hard for me to see some lowlights, but one of them would be inconsistent comp sales growth. They have been growing comp sales every year until this year, but it's not super linear. Sometimes the comp sales go up because the average ticket was up. Sometimes it's the amount of transactions. Sometimes one of those two factors actually goes down. So they don't seem to have a clear strategy about driving more tickets or the size of the ticket. So that's the one low light I will point out.
Yeah, to be honest, I was having trouble finding low lights too. I think the business model is, I don't want to say bulletproof, but pretty darn sound. Ryan, you want to hit yours?
Yeah, my highlight is the strong economics of the business model, profitable after a year or whatever. That's the payback period, which when you're profitable that quick, it allows you to expand a little bit faster because you can do it organically with the cash flow that you have and not require outside debt. But low light for me, the share repurchase felt really random and unwarranted. It was tiny, but it was like $100 million over the next 4 years, which just felt like wasted cap. I mean, they're not cheap. They're not like a screaming.
Yeah, let's get some CapEx going. Yeah,
just like why not just speed up store count? I guess with that 100 million.
I don't think they actually bought anything yet, so maybe it's just out there in case they're price plummets.
It felt like a shareholder tease. Like we could if we wanted to,
with a model like this, it honestly feels like once they get to scale, the ideal situation is someone like AutoZone, where they destroy 80% of their shares over the, once they hit kind of the saturation, like AutoZone really didn't have, or I think it's AutoZone, right?
I think
whatever company it is, and there's other examples where they kind of hit market saturation, which Five Below is going to do eventually with their current model. If the valuation stays like low, right now it's a bit high, right? If it stays fairly low, you just buy back a ton of your shares, but that seems way into.
That's my worry, is that it feels like there's a ceiling. It feels like, all right, let's say 2,500 is that threshold of store count. You could see them easily getting there. That's great. Some of that might be priced in, but then what do? Raise prices? Like, your store is built on not raising prices. That's the whole narrative. I guess, Ian, do you have a point to that?
Yeah, just the only point is then you start thinking about international. That's always what management teams say, and it's a little bit cliche, but I think for Five Below, once they started to tap out or got close to tapping out in the US, they'd say, hey, let's go check out the international thing. So
yeah, and there's some countries that this type of in general, some countries seem to hate chain stores, but there's plenty out there that kind of like chains, and I would think this model would work anywhere. I
don't know. I wouldn't.
Yeah, I mean,
I wouldn't know the other demographics as well. But
I guess you gotta really cater to the each culture is different. So
yeah. What about you? Highlights.
I mean, the predictability is probably my favorite part. It's so simple, but it's like, I said, it's almost bulletproof. Stores are profitable within a year. I think that was each of us had that. And that gives them the opportunity to spend about $200 million on CapEx each year while staying free cash flow positive. That is a great advantage. And I do love the defensibility versus Amazon or Walmart. Like there's not really, Amazon can't invest $5 billion and crush them. It's really not going to happen. Lowlights, though, again, the market saturation thing. The comp sales, again, were a bit of a worry, but those are a bit of a stretch. I don't know if this one is real, but does inflation hurt them at all? Ian, you seem to know the business a bit more. Do you have any thoughts on that? Is that
No, it's just a name change. 6 Below.
6 Below, 7 Below. I know they have the 5 Beyonds, but they can't make that the entire store.
Yeah, I suspect what we'll start to see over the next few years is, they do seem to be pretty creative with their names. So they may come up with a new name and be able to up their prices a little bit. But I do expect that maybe it'll be a slow transition, but we might start seeing more and more 5 Beyond goods and less 5 Below goods. And that they may even be looking at that as the name of the future, but we'll see. I don't know. I think it's a little bit of a concern because they have built their brand so much around 5 Below, quality, inexpensive goods. But I assume that that they've got some sort of plan for that.
5 Below in parentheses, inflation adjusted.
Inflation. Yeah. Exactly. All right. I think that's going to do it.
No?
More or less interested.
Well, first of all, it's the 1-year anniversary of the market bottom today.
So I was looking at their 1-year returns and I was like, wow, 100%. I was like, oh.
It was like $60 a year ago. I think right now it's at 192.
Yeah.
I mean, every 1-year chart looks incredible right now.
Yeah.
This
is one. Oh, go ahead. Sorry, Ryan.
As I say, more or less interested in.
Yeah, this is one that I took a look at back last summer. And it's one I'm kicking myself a little bit for not getting any of because, like you said, the 1-year chart looks amazing. But I'd say every time I look at this business, I get a little bit more interested just because of how good, simple, predictable it seems. And, you can never it's hard to discount that, right? To say just a good, solid company, right? And that's at a fairly reasonable valuation comparatively, right? We could argue about valuation all day long, but compared to a lot of the things in this market, this does not have a crazy multiple on it right now. So I'd say I'm slightly more interested.
All right, Ryan.
Yeah, normal. I mean, I'm less interested. I know this is kind of against
haters.
I know. I don't know. It doesn't get me super excited, and this feels like. I mean, normalized, it's trading at an operating income multiple, probably like 50.
Yeah, 40 maybe, but yeah.
That isn't, I know that's cheaper than comps, but I guess this is the kind of business that I'd like to own if it were screaming my name. Right now, it just doesn't excite me. And something just feels daunting about the fact that they've kind of capped themselves out. Whether it's the 2,500 stores, the $5 price limit. I know that isn't really a threshold, but it feels like they're going to have to sort of contrast against their narrative in order to raise prices or do more $5 plus stuff, or they're going to have to expand internationally. But I don't know. It just feels like I always hate investing with a cap, like a theoretical cap.
Yeah, and a good management team might surprise you, but yeah, that is definitely a concern here.
I mean, the esports, I guess, provides some optionality, but it feels like if you're talking about optionality with this business, it's kind of you're just trying to justify the current valuation.
Yeah, I mean, valuation is the concern for me as well, but I do think the business is. I mean, it sounds bulletproof. I've said it like 3 times. It's just so simple, so predictable, but it's not, I'm more interested, but the business is something that I feel like is going to be on my watch list forever. At 40 times normalized earnings. So would I be surprised if it outperforms the market? No, but I don't know.
Let me pose this question. What multiple do you think this would trade at maturity?
At maturity? I don't know, 25. It would definitely get a decently premium multiple.
A little bit above
market average. Yeah. If I'm saying the long-term market average is like 20, I'd say this probably deserves like 25.
So that's, I guess my concern is, let's say it's 25 times or even 30 times. And right now we're all saying it's a very predictable business. That's why it trades at 40 times, no?
Yeah. No, that's true.
I mean, I guess right now it trades at like 70 times trailing, but the trailing numbers are off because of COVID. I guess that predictability, it feels like maybe that's what the market's pricing in.
Oh,
yeah,
for sure.
I think it's the type of thing that if you're looking at this a year ago, it's much more, and I didn't see it at the time, but it's a much more attractive thing. And I think this is, at least for me, this is that type of stock that I try and keep on my watch list. And if something like COVID happens again, that, where it just has this huge drop and you think, okay, maybe time to pull the trigger on this one because it's you're going to get some outsized returns over the next few years. But like you were saying, Brett, I would expect, this thing, it wouldn't surprise me if this thing was a 10 to 15% compounder for the next 5 to 10 years, but it's probably not going to be the thing it's not these micro cap picks that are going up 100% in 3 months, right? It's not that type of return, or even 100% in 2 years. It would surprise me if it doubled again from here in the next 2 years. So.
Yeah, I think the biggest thing that would concern investors is just boredom with this business. I think you would just get bored. And I guess most people, I think, do.
I mean, Ian brings up a good point there. Like, maybe you're paying a little bit of a premium now, but the forecasting of the business or of the fundamentals from here is pretty easy.
10% margins at least.
So it makes buying on downturns a lot easier as well.
Yes, for sure. All right, we're gonna wrap things up.
What stock do you have for next week?
Yeah, I think you guys are gonna like this one. It's gonna play off with a fashion thing I did 3 weeks ago. We're gonna do Farfetch.
Okay.
I don't know what the business is at all, but a lot of people seem to like it. They're throwing out 80% revenue growth, and I'm like, all right, cool. Let's just take it out.
Gotta love top line growth.
Yes.
Yeah, and everybody knows we're the fashion experts, so that's the most fashionable people on FinTwit, right? That's what people call us, right?
That's exactly right. Value investors are known for their fashion. Buffett is basically no. But that's going to do it. Thank you all for listening. Thank you for Ian for joining us. Remember, we are not financial advisors, so anything on the show is not formal advice or recommendation. Ryan and I are general partners at Arch Capital, and clients in Arch Capital may hold securities discussed on this podcast. Am I missing anything? Thank you all for listening. We'll see you next time.